You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. This is your host, Jennings Smith. Guys, today it's just me and you. I've got a message I want to share with you, and I wanted to bring it direct from the horse's mouth. How to go broke syndicating apartments or really make little to no money. And this may be something that turns you off about apartment syndications. I know it did for me when I looked into how it's done. And when I say how it's done, I mean the powers that be, right? These are the big dogs in an apartment syndication. These are the hedge funds. These are the guys that are wearing the suits, that have done it forever. And you feel like when you think of an apartment syndicator, this is what you think of. And there are social norms, right? There are societal norms. And we think this is the way that it always has to be, right? And so the typical syndication model is 70 to 80% of the equity of the deal is given to the syndicator, to the investor, right? The people that are bringing the money. There's two halves, right? You got the investors who are bringing the money. You've got the general partners who are bringing the deal, signing the debt, doing the work, and doing the value add and running the deal, right? General partners and limited partners. And in a typical deal, the limited partners, they get 70 to 80% of the deal, and the general partners get 20 to 30%. On top of that, a lot of times, the limited partners, the money guys and girls, they get a preferred return of 6%, 7%, 5%, 8%, just depends on the deal, right? So that means that they get the first, if it's an 8% preferred return, they get the first 8% of the profits out of the deal. And then they split the deal 70-30 or 80-20. And so if you're a guy like me who's looking to be a operator, right, looking to buy apartments and own them and get the equity, you're thinking, okay, so I got to source a deal. I've got to raise all this money. I got to get the debt. If I can't get the debt, I've got to get somebody on my team that can help me get the debt. If I can't raise all the money, I've got to get somebody to help me raise all the money. And maybe I'll have somebody that found the deal and they're going to want a little bit of equity. And so I'm splitting up this little 20% or 30% piece of the pie 2, 3, 4, 5 different ways. How much equity am I really ending up with? And then on top of that, I still have to give away the first 6, 7, 8% of the returns to the investors. And then I split it after that. And I'm getting maybe 20% or 30% of the general partnership. So I'm getting 20% of 20% of the deal is 4% of the deal, right? So pretty minimal slice of equity there. Now, the way these guys make money, right, the way this can start to make sense is, well, there's an acquisition fee, typically of 2 to 3%. So let's just take an average deal, right? I'm just going to use round numbers. So we'll say this is a $10 million deal, right? So decent sized deal, big boy deal, $10 million. And it's split 80-20, right? 80 to the investors, 20 to the general partners. There's a 3% acquisition fee, right? So 3% of $10 million is $300,000, right? So $300,000 in cash is paid up front to the GPs, okay? Then there may be a 2% asset management fee. This is 2% of the rents. So if the apartment complex, let's just say, it's $10 million and they're $100,000 a unit. And so that's 100 units, right? And these are renting for $1,200 a month. So you've got $1,200 a month. I'm just going to do the math here on my phone. So $1,200 a month times 100 units is $120,000 a month times 12 months is $1,440,000 times 2%. So there's another $30,000, $28,800 in fees paid to the syndicator per year, right? And then there may be a 2% disposition fee or refinance fee. It's called a capital event fee, right? So 2% of 10 million is another $200,000. So Yeah, they're not getting a lot of equity, but they're getting $530,000 in cash, plus another $30,000 in cash per year, or the asset management fee. So there is a way to make money, but essentially you're getting paid fees, right? You're really not getting paid on performance. You're getting paid to raise the money. You're getting paid to close the deal. You're getting paid to sell the deal or refinance the deal, and you're getting paid on the rents that you collect. So yeah, you are incentivized to collect more rents, and you are incentivized to do well by your investors. But, you only own 20% of that deal, right? The biggest frustration that I have with that model is I'm looking for long-term equity. I'm looking for something that is going to build my life, build my lifestyle, right? I'm looking for something that in 20 years is paying me every month, is fairly well paid down, is worth a lot more than I've paid, and I haven't just constantly leveraged it up, and I haven't constantly sucked all the money out of this deal, and I've got a real retirement nest egg that is not only cash flowing, but there's money sitting there, right, in the asset. Because the other thing is, think about this, guys. On a $10 million deal, you're typically going to have 70% of debt, right? So there's $7 million. And then you're going to have the other equity is raised from the investors. There's $3 million. And so if you raise the valuation of this property by, let's say, 10%, right? So a typical fairly skinny syndication deal, they're only going for a 10% value add, right? So they raise the value of the building to $11 million. Let's just say a little bit more, but they net $11 million after their closing costs. Well, you're talking $1 million in profits. That's before you pay 8% on $3 million for however many years it took you to turn this property around and sell it for $11 million, right? So if it's 8%, let's do the math. 8% on $3 million is $240,000 a year. If it takes you 3 years, right, there's $720,000 in preferred return that goes to the investors, right? Minus $1 million. That's your profit. There's only $280,000, and you're getting 20% of that, $56,000, right? $56,000. So of all the money you made, you almost made $500,000, but $56,000 is all you got from actually doing your job and making the property worth more and selling it for more. And so that model just never really resonated with me. Now, this model is popular. Yeah, why do people do this model? Why is this the go-to model? Why is this what everyone is doing? Why is this, when you get into apartment syndication, this is what you hear. It's 70-30, it's 80-20. Well, the reason is because it's built like a business, right? So there's cash flow generated from acquisition fees, there's cash flow generated from asset management fees, and you have to be constantly closing deals. And if you have to be constantly closing deals, right, no matter the market cycles and really no matter the price, you've got to be willing to pretty much pay retail prices, right? Because to find phenomenal deals, it takes time, it takes effort, and they don't necessarily come along every week. Right? There's certain times of the market where they're definitely more plentiful, and there's other times where they're definitely more hard to find. But if you're trying to do this as a business model, right, and you have employees, and you have a team, and you have asset managers, and you have property managers, and you have overhead, and you have offices, and you have everything else, right, you have to be constantly and consistently closing deals. And so does that incentivize you to only close the best deals, or does that incentivize you to close a deal, right? As long as you can get an acquisition fee, you can maybe make it cash flow, and you can get a disposition fee and the asset management fees, your business model works, right? 90% of your profitability comes from just closing deals and getting the asset management fees, right? And selling them. Only 10% in this example is actually coming from the value add, right? From making the $1 million, you're only getting 10% of your total profit on this. And then when you add this up, so let's say the investor, right, they made, I think it was like $750,000 in the preferred return, and then they're getting 80% of the additional $250,000. So there's another $200,000. So they made $950,000. You made $550,000, $600,000. Does that really sound like an 80-20 split deal? Right? Not to me. It's closer to 50-50, 60-40. Right? And so these fees kind of make the investors think that they're getting this great deal. They're getting all this equity, but when you add back in the fees, the equity split is not that when you divide it by how much money did each party put into the bank. And you need to realize that whether you're an investor or whether you're a syndicator, whether you're trying to buy apartments and grow your portfolio, you need to be aware of that. Because I would propose that maybe there's some other things we can do. And if you stick around, I'm going to get into that. How can we do it a better way? Right? So my biggest frustration with this model is I don't see the goals are aligned. And there's little to no equity long term to me. Now I'm generating cash, but acquisition fees, they got to be paid by someone. And really, they come right out of the investor's pocket. And I'm not against acquisition fees. I take acquisition fees. It's very difficult to find these deals, to source them. It's difficult to raise money. It's difficult to get them closed. And that upfront cash at closing of 1-2%, it really is necessary and needed. But the cost that it's having to do these is great, right? One, you're not aligned. Two, you're also pushed and incentivized to just close the next deal, right? To make the next acquisition fee, to make more asset management fees. And three, these are very skinny deals. If you think about if the syndicator has to give away 70 or 80% of the deal to make the deal work, and they only own 20 to 30% of this deal, and that deal starts going sideways, right? There isn't much that the syndicator can do. They don't have a lot of equity that they can dilute themselves and sell more equity in the deal, right? They don't necessarily have a ton of upside incentive, right? They've already been paid and they're not making much money on the upside. So how incentivized are they to dedicate a ton of time, effort, and resources, AKA capital injections? And so what they do is capital calls, right? They go back to the investor. Hey, you guys own 80% of this building. We're short $100,000. We need $100,000 to shore up these renovations or whatever it is, right? And so the investors have to pony up more cash or they get diluted. So you may not realize that about investing in apartment syndications, but it's kind of a blank check, right? When you write that check, you get equity in that property, but if they need more money in the future and you don't pony up, you get diluted, right? So you get diluted by the other investors that did put in money or the GPs that put in the money. They're taking some of your equity, right? Because you did not pull your weight. And so capital calls are not very popular, right? And knock on wood, we've never done a capital call in any of our deals. Now, we've had to pause preferred returns. We've had to inject capital into our deals, but we have not had to go back to the investors and ask them for more money, more capital injections, which I'm grateful for. But there's a reason for that, and we're going to get into that, and so that doesn't happen to you, hopefully. So the costs that this model was having was, one, I wasn't really too excited about it. I wasn't going to make enough equity. It wasn't really going to change my life long term. When I wake up and I'm 50, 60 years old and I own 3% of some deal that's been refinanced a million times that the investors own 80% of, right? That's not really changing my life. And so the cost that kind of thinking can have, like, I'm going to just do it the status quo way. I'm going to do it the way that all these other syndicators do it. This is kind of the way it is that I wasn't closing deals. I wasn't pursuing deals. I wasn't trying to solve and figure out this problem of buying large deals and keeping decent amounts of equity, right? So what we started to do was this, and I want you to listen closely because this kind of information can really change your thinking on this stuff, and it can ultimately change your life if you apply it. So what we started to do was hunt deals that really made sense. Hunt deals that were really, really good. And I know this sounds elementary, okay? But if I'm looking at a deal where I can give away 20 or 30 or 40 or 50% of the equity, and I can make the investor a 15 to 20% return, right? Then that's probably a good deal. If I have to give away 80% of the deal just to make them a 15% return, that's probably a pretty skinny deal. And it's a lot of work to get that thing closed, and it's a lot of risk, and it's a lot of effort. And so am I willing to take that on? No. And it just becomes a feature of your underwriting where you're looking at stuff. It's like, can I close this? Can I make my investors a great return? And can I keep a decent amount of equity so that it's worth it to me? It's worth it to me to take on this risk and to cross this bridge and to asset manage and run the renovation plan and all the stuff that you got to do to make this apartment deal work. Is it worth it to me? So if I'm getting 4% of the deal, no, it's probably not worth it to me. But if I can get 50% of that deal or 70% of that deal for my GP team, then yeah, that's worth a lot of effort and work, right? And so the flip side, I want you to take it back to a deal that we did in Tulsa, Oklahoma. This was a 208 unit. It was $8 million deal all in, $5.5 million purchase price, $2.5 million renovation. And we had to raise $2.5 million essentially out of from our investors. We got the rest with debt. And the way we sourced that deal was, or structured that deal, was a 10% preferred return. So the first 10% of the deal, all the cash flow and all the profits had to go to the investors, right? Now, this doesn't have to be paid up front, right? It doesn't have to be paid monthly or quarterly. Now, the more regularly and the quicker you can pay it, the more attractive that is to the investors. But the way that structure means is that they get paid first, right? So that was one component to attracting capital, was they were going to get a 10% preferred return. The other thing is we were going to do it quickly. We were going to be able to refinance this deal in 2 years or less and return the capital faster, right? Now, things have changed, right? Because right now the rates have gone way up, and a refinance that made sense 2 years ago with where the rates were, or even 12 months ago, doesn't look so attractive now. And so there's definitely drawbacks to this model. And I'm going to talk about a couple different models that you can use, because I want to be clear that there is no magic bullet. This is the best model. It works in all instances and it's better than any others. But it did work for us in this instance, right? We brought this deal in 2020 and we refinanced it in 2022. So the rates were still low. We got a 4.25% right as we refinanced it last summer, right as the rates were starting to take off. And we returned all the capital, and we were able to keep 80% of the equity in that deal. So the investors got their 10% preferred return. They got all their money back. There was excess cash when we refinanced it. So it got appraised at $14 million. They gave us a loan for $9.5 million. We paid our investors off. We distributed out about $500,000, and we kept the rest in the bank for future repairs, roofs and air conditioning, all that kind of stuff. And so now I love that deal, right? That deal consistently cash flows $20,000, $30,000 a month. I don't owe the investors any money. They've gotten all their money back. They're getting 20% of the cash flow. I'm getting 80% of the cash flow, and they own 20% of the equity in that deal, right? So the equity is about $4.5 million, right? So $4.5 million is about $1 million in equity towards the investors. So they not only got a 10 pref, right? 10% on their money while it was in the deal. They not only got their money back quickly, they retain equity. Now they have no risk in the deal. They took on no debt, and they're getting a check every month from the cash flow. I mean, it's not a lot, but if we're cash flowing $30,000 a month, they're getting a check for $6,000 split between the investors. So not huge, but when we sell, they're going to get a check collectively. If we sold it today for $14 million, they'd get a check collectively for about $1 million, $950,000 split between the investors. So that's another 50%, 40% on the money, right? That was tied up. So it did turn out to be a good deal for the investors, and it did turn out to be a good deal for me because that deal was messed up. I mean, it was 50% vacant, ton of risk, ton of work, and I was willing to do that because we were going to be able to get a decent amount of the equity on that side. Another deal I did was the first deal I ever did. It was a 12 unit. And I kept 60% of the equity. I gave the investor 40%. And there was no preferred return. It was just a straight up split. I said, whatever this thing cash flows, you get 40%, I get 60%. And when we sell it, you get all your capital back. And then we split the profits 60-40. And he was good with that. We ended up selling it in 2 years. And we made we made a good money. We made $160,000. And so he got 40% of that. I got 60% of that. So every deal that I have done, I have structured it in a creative way, right? I've done deals with seller financing, seller carryback, where the seller is financing the down payment. We're getting the primary loan from the bank and the seller is giving us the down payment. So they're getting less cash at closing and they're agreeing to like a 2 or 3 or 5 year loan to pay them the rest of the remainder on the purchase price. But that eliminates the need for a down payment. Therefore, it eliminates the need for investors. Therefore, we can keep 100% of the equity of that deal, right? And this is when deals got a lot more fun. This is when multifamily got a lot more attractive to me. So will I ever close the 250 unit Class A in downtown Dallas? That's $250,000 a unit. Probably not, right? My model is not built for that. And what I'm comfortable with and what I'm doing is not built for that. But most of those deals are, I don't feel very well aligned with the investor, and they're mostly banking on appreciation. If I can get into a deal that's cash flowing, then I feel a lot safer with that. Cash flow can solve a lot of problems, right? Now, I'm going to talk about a couple deals that we're in that aren't going to plan, right? And I'm going to go back to how the 10 pref, that knife can cut both ways. So we closed the deal, Mill Run in Georgia, and that deal is going well, right? We're 95% occupied. We've raised rents. We're pretty much done with the renovations, and we still got to do some parking lot work. But the thing is we got over on the budget with the renovations. So we had to stop the preferred return, direct that extra cash towards the renovations. And, as an investor, that's not ideal. The other thing that's not ideal for the investor is we weren't able to refinance it in 18 months. So that was kind of our plan, was 18 months to 24 months refinance. And yet when we look at refinancing out the initial debt, which is cheap, with the investors, which are at 10%, right? It doesn't cash flow anymore because I can't get a rate like I could before. Now my rates are 6.5%, 7%. However, it's a cash flowing deal, right? It's a safe deal. Every month that property creates cash flow. And so my plan is communicate with the investors. Hey, the Fed has raised rates 300 to 400 basis points in the last 9 months. I didn't see that coming. I can't control that, but we have hit our revenue projections. We have hit our expense projections. We are almost done with the renovations. And when we're done, our plan is to turn that preferred return back on. And we're just going to kind of tread water. We're going to pay the preferred return, tread water, see what happens. Because if I don't freak out and I hold the course and the Fed drops rates down to 5% or 4.5%, all of a sudden, it's going to make a lot of sense for me to refinance that property or even sell it if I want to sell it at that point. But if I have to take a refinance option now, I'm pushing up, like I'm just paying more interest than I had. And I got a 5-year loan initially, so I have time, right? I didn't get into a short-term bridge loan. So the two deals that I really got jammed up on were both 2-year short-term bridge loans, and we ended up selling both of those to just get out of that debt because I didn't have time on my side where I can wait out the Fed, I can wait out the rates, I can see what happens with the market. Now you may say, well, what if the Fed keeps raising rates and in 2 years, the rates are even higher than they are now? Well, that is a possibility, but right, the Fed just can't raise rates infinitely. There's issues we're seeing, right, with the banks. Those rates getting too high are breaking the bank's liquidities. And so I don't believe that's going to happen, but if it does, or if rates don't really come down over the next 2 years, I've still executed my business plan. I've still increased the rents. I've still got my renovations done. I've still improved the property, and therefore I can sell that property for way more than I'm into it. So I'm still in the black. Maybe the refinance doesn't work. Maybe I can't do the Burr model, cash out refinance and hold it for 10 or 20 years, but I can sell it. I can pay the investors their money back. I can pay them the preferred return, the 10% that's accrued. I can give them their share of the profits, and I can make my share of the profits, and we can all move on and fight another day, right? So there's a lot of variables with this, and that's where I'm saying it all originates with getting a phenomenal deal, right? Because if you can get a really good deal, then you're going to be able to have multiple exit options. You're going to have multiple ways to pivot. It's when you are paying retail price and then a few things move against you is when it gets really, really hairy, really, really quick. You know, I'm talking to a seller right now who bought their property a couple years ago, 5 years ago, got great debt. It was stabilized. It was in good shape. It was in a good part of the market, and it was full, and they paid top dollar, right? They paid the highest price per square foot that had ever been transacted in that city. Okay. Now, 5 years down the road, the price looks okay. However, they've run it into the ground. Not into the ground, but it's not going well. They've got 10% vacancy. They've got another 10% economic vacancy, and then they've got another 20 units that are down, right? They had a fire. And so this property is heavily distressed, right? 40%. If you add that all together, it's about 40% vacancy. And so they don't have a lot of good options, right? They can't refinance. They can't sell for what they have into it. They've got high vacancy. They can't get better debt on it, right? The debt they have now is the best debt they can get. And so a seller or a buyer could assume their loan and they could sell or finance the balance. And that's kind of what I proposed to them. But they don't have a lot of options at this point. And not only that, I looked at the T12s, and the property's losing a couple $100,000 a year in cash flow. It's not covering its costs. So not only is the investor not making any returns, they're losing money, they're losing their principal, and they're losing more of their principal every year. They're having to inject more cash and throw good money after bad. So I don't know what's going to happen with that property, but that's where you pay top dollar and then things go against you, right? You had a fire, you had a bad management company, you didn't get it filled up, you had vacancy, you had people not paying, et cetera, et cetera. We all struggle with this. We all deal with these things, and they come up from time to time. But if you're getting into something that is a great deal, you can overcome that. You're going to have options. And that's why when we're encouraging people in their underwriting, you can't be underwriting these best case scenarios. You need to be as accurate as you possibly can. So when I started to take these actions and really apply these principles and these structures, this is how Yaden and I have been able to build a $63 million portfolio, and we own 48% of the equity in it. So if you're listening to me, maybe you're thinking, oh, wow, 63 million times 48%. I wish, not quite, because we have debt. And some of those properties we have not refinanced and returned the investor capital. Some of them we have. About half of the properties we have, the other 3 or 4 are still in various stages of refinance. And so we've got to get that capital back. But the point is, 20 years from now, if we still own those properties and we haven't refinanced and sucked all the money out of them, we will have them significantly paid down. We will have the investors cashed out, and we will own a large portion of the equity. And maybe that $63 million worth of real estate, if we take care of it, it'll be worth, 50% more, right? Real estate goes up an average 2% a year, compounded. And so 63 million times 2% is 1.2 million a year. So there's another 20 million. And then when you compound, because it's 2% compounded, let's just say it goes up to maybe worth 90 million. 90 million, and we'll say we still owe 30 million on the debt side, right? So there's now a $60 million nest egg there that we have of equity that if we liquidated the portfolio, we would get 48% of. And I'm proud of that because we've structured these deals in a way that it's worth it, right? It's worth our time. It's worth our effort. Am I there yet? No. We still have a lot of investors that we've got to pay back. We still have to refinance and stabilize some stuff. And we've got to pay down debt. We got to amortize debt, and we got to let the market go in our favor. But all those things are going to happen for sure, right? And that's the result of going anti-syndication, right? Taking the status quo model of I'm going to go out there, I'm going to find an average deal, I'm going to pay retail price, I'm going to give away 70, 80% of the equity, we're going to hold it for 5 years, and we're going to sell it, and I'm going to make a couple $100,000 over 5 years, right? That was not where I wanted to go. That was just another job. That was just trading my time for money, and that was also possibly not aligning my interest with my partners, right? The capital partners. And so the result of going anti-syndication and using creative financing, using seller carrybacks, utilizing private lenders, only finding deals where it makes sense to do that, right? We bought a deal with a guy in the deal room. He brought it to me and it was a phenomenal deal. It's 34 units in Ohio. You've heard me talk about it. We bought it for $1.2 million. We got debt and we had to bring about $500,000 or $600,000 in cash to closing for the down payment and for the renovation. And so instead of raising that money and giving away equity, we got the money from 3 or 4 different private lenders at a 15% promissory note paid monthly, right? It's just like a loan. And you can only do that when the deal is a smoking deal, right? Where you have enough cash flow to do that kind of thing. But we were able to do that and we were able to keep 100% of that deal. The deal room guy got 50% and Yaden and I got 50%. It's a phenomenal deal. It's working out great. And we're going to get the rents where we want them to be. And then we'll refinance out that money at 15%, right? If we can't, then we can extend that loan for another year or we can replace them with new money at 15% because that's a pretty good rate. There's a lot of people that are attracted to that rate, especially if it's backed by a stabilized cash flowing multifamily apartment, even if they're in second position, right? So there's a lot of ways to buy a lot of real estate, get a lot of equity without just doing what everybody else does, right? Following the masses is typically never right. Following the masses doesn't work. Okay, so go your own way. So how do you get started, right? You're like, Jennings, I get it. I got to find great deals. How do I get started? Study different models, right? Familiarize yourself with the foundation of how do I structure these different ways, right? There's a million different ways to structure these deals. And the sky is the limit. And as much creativity as you can utilize, especially if the seller is willing to be creative with you, you can really make a lot of deals happen in a lot of different ways. But you have to understand the models, the good parts about them, the bad parts, the risks, right? So if you do a deal with a 10% preferred return, you realize you're not making a dime until you refinance that, right? You're not making it. All of the investors are sucking all the cash out of that deal, right? Until they get the first 10% on that. And 10% cash on an unstabilized property, like it ain't happening a lot of times. So you have to realize going into that deal, like I'm not going to get paid on this for a couple of years, but then I'm really going to get paid, right? Because I'm going to own most of the equity. Or you could go into a deal where maybe it's a great deal, but you give away 50, 60% of the deal and there's no preferred return and you're splitting cash flow right out of the gate, right? And you set the expectation with the investor that we're going to refinance this in 5 years. We're going to cash flow for 5 years, then we're going to refinance it and I'll get you the capital back and then we'll go from there. Maybe you change the equity split after the refinance. After they get their money back, now maybe they own 25% of the building. Just depends on what you can get them to go for and what you're willing to do. But you have to understand the foundation. So in the deal room, we focus on step one is the foundation, right? We have a $2,000 course that we built. It's 96 videos, 10 hours worth of videos, A to Z, every type of structure, and every way you could skin a cat with the deals, private placement memorandums, the legal structure, how to source deals, how to raise money, all that stuff. And that's the foundation, right? That's not enough alone to close a deal, but it is a great starting point. The foundation is key. The second thing is sourcing these off-market deals. Instead of just going on LoopNet or Crexy and saying, wow, there's no deals, you've got to start directly reaching out to brokers, right, who have the inside track on these deals, and you got to directly start reaching out to sellers, people that have multifamily apartments. There's a website, it's called Reonomy. It's a membership, you got to pay for it, but they'll tell you what people's debt is. They'll tell you when their debt is expiring. They'll tell you how likely they are to sell. They'll give you their phone numbers, their email addresses, all that information you need right there to cold call and start talking with sellers because we can get direct to them. A lot of times you can move into point 3, which is utilizing that creative financing where they're willing to hold some of your down payment, right? Utilizing creative financing with hard money lenders who will loan you money in second position, maybe at higher rates, but the deal is so good that it makes sense because you're sourcing these off market and you don't have competition for them. So if this is something that you want to do and you're like, hey, this is intriguing, but I'm a little bit like, what do I do next? Hit me up, shoot me a message. I'm happy to talk to you. if you're already in real estate full time, or you already own a couple rentals, right? If you're like a realtor, wholesaler, contractor, house flipper, or you have a portfolio currently already and you want to scale into multifamily, then we can talk about the deal room, because I know it will work for you. If you're not there yet, you're not in real estate full time and you don't have any rentals, still reach out to me. I'm happy to see what I can do, but we need to keep the deal room to only those experienced people, because that way I can guarantee the deal room will work for you. So guys, that's what I got for today. I appreciate you. Thank you for spending some time with me. It's the most valuable resource. And this stuff, it took me a while to kind of formulate my thesis. So I hope it was valuable. I hope it was useful. If it was, drop me a comment, drop me a like, drop me a review, shoot me a message. I read them all, I respond to them all, and they mean the world to me. So guys, have a great week, and make sure you take time to unlock your life. Peace.
This is thepodcastfactory.com.